The Iran war crisis is officially over. Stock markets reach all-time highs and we're off to the moon. All this and more we'll discuss in this episode number 24 of my investment journey, where I invest €1,000 a week. And so as always, we start with the trade, which at the moment still is my €1,000 weekly investment in the MSCI emerging markets. So let's go ahead. Let's put in the €1,000 here. Order placed, boom, we got it. So let's check out the wealth tab and we're up to €26,000. The portfolio has really developed beautifully, especially after the ceasefire agreement between the US and Iran, and investors take this as a very positive sign. And so my portfolio over the entirety of this experiment is up €2,000. At one point, we were already up with my portfolio to more than €1,500 in profit. But then the Iran war happened and the portfolio tanked, much like the stock markets, and I was actually in the red. But as you can see, the market has completely relaxed and I'm up to an all-time high of, like I said, €2,100, 9% up in total. And it isn't just my portfolio, actually the markets as a whole have been up nicely. Second week in a row where we have a beautiful development. MSCI World is up almost 3%, MSCI Emerging Markets is up, closer to 4%. Now what has actually happened that led to this relief rally? Well, there was a ceasefire between the US and Iran in order to negotiate a long-term peace agreement. These talks that happened in Pakistan have failed. And both sides tried downplaying it, saying, well, we don't care, you need the end of this war much more than we need it. And so in a surprising turn of events, the US has decided that when they can't end Iran's blockade of the Strait of Hormuz, that the US is going to blockade the Strait of Hormuz themselves. And it's actually a super interesting move in a way. Do I trust the US government to be led by strategic geniuses at the moment? No, absolutely not. But in this case, the US blockade on Iran seems to be working. The thing was that while Iran controlled the strait, they could still ship their oil in and out, and so they benefited from the increased oil price and they made more money than before. At the same time, they let Chinese ships pass through, so China never really felt the crunch in the oil markets as much as everybody else. And China is of course a huge ally of Iran and the big geopolitical opponent to the US. And so it's still not clear what's going to happen. At the moment, there is no peace agreement. We have the ceasefire that seems to be more or less observed, but I'm not sure. But as far as I understood, in the negotiations for peace, it became very evident that the two positions are very, very far apart. And I don't know how this can be reconciled. So for example, Iran wants reparations for the damages caused by the war. And the US, of course, want Iran to stop funding terror groups in the region. Those are some of the demands and they seem to be not reconcilable. But whatever. The main thing that seems to be happening right now is that stocks hit record highs as Wall Street looks beyond the war. And so you can see this here. Investors appear to be treating an end to the US-Israeli war with Iran as a foregone conclusion as the S&P 500 closes above 7,000. So you heard it right. The S&P 500 hit an all-time high now, reaching 7,000 points. And so a Barclays analyst here is saying the market is trading assuming we have seen the worst of the conflict, which is crazy as expressed by Christine Lagarde, the president of the European Central Bank. And so what she says is, what's a little strange is that there is a tendency by some to assume that it's business as usual. And I think she's right to be concerned about it. The war isn't even over yet, and the energy markets, even if the war were to end today, will still be disrupted. There are backlogs in the shipping and transportation of crude oil, strategic reserves have been depleted, and some of the production capacities to produce oil and gas in the Middle East have been destroyed, which takes years to rebuild. So it's not some short-term thing that's going on here. And in a fund manager survey that was conducted last week by Bank of America, it showed that the investment managers had the most bearish outlook on the market since June. Horrible. But the good thing is that very few of those fund managers thought that this ongoing conflict would lead to a recession. And that combined with the strong backdrop provided by corporate earnings makes them optimistic. So analysts expect a sixth straight quarter of double-digit earnings growth, with some anticipating the best earnings season in roughly 5 years. And that's probably the main point here. Corporate earnings are the biggest driver of stock returns. On the other hand, of course, as it is expressed here, the obvious risk is that we have not seen the worst of the conflict yet. And so, in such a difficult situation, you might be asking yourself, how can I invest in the stock market now? I mean, we're at an all time high while the situation is risky as hell. And what I wanted to do was look at the S&P 500 PE ratio. Here you can see the price to earnings ratio. And the higher that is, the more expensive the stocks are. And that in the past has correlated with returns. And if we look at the whole history of PE ratio, we have, well, there's one outlier that destroys the graph a little bit around 2009. But historically, the PE ratio rarely exceeded 20. And when it reached 20, then it was typically a precursor of a recession or a bear market. But now you can see that today, the PE ratio is at 30 again. So now it seems to be the worst time to buy. We're not at 20, we're at 30. And so now I'm also asking myself, should I invest now? Isn't it the worst possible moment to invest? Have I missed the right moment? And after thinking about it for a bit, the one thing that popped into my mind was, you know what? What's going to happen after this crisis? I think there's going to be a huge inflation, which means corporations raise their prices, your money gets worth less, but at the end of the day, the stock market will rise. And there's another interesting chart that I found that explains this quite nicely, and it is the S&P 500 forward PE ratio. What does that mean? Well, we're not looking at today's earnings, we're looking at earnings in 12 months' time, so 1 year from now. And what happens here is, of course, we're expecting earnings to grow. And if they grow a lot, then the PE ratio that we're seeing today is not as meaningful. If I have a PE ratio of 30 and then next year the earnings double, then if stock prices were to stay the same, you'd have a PE ratio of 15. And as you can see here, the forward PE ratio of the S&P 500 is much less extreme. You can see here it is at, somewhere between 20 and 21, which is not even close to historic highs here. And that's driven by strong US earnings growth. I am investing in the MSCI emerging markets, I know, but for simplicity, I'm explaining all of this with the S&P 500 and the US market because it has the best data and the effects are the same all across the world. And so with a little bit of research, I found this, which is a historic chart over the last about 10 years, where you can see the 12-month forward PE ratio and where we are right now. And that is between 20 and 21. And as you can see, we're not far away from the 5-year average and just a little bit above the 10-year average. So potentially stocks aren't even as expensive as they seem. And what is this driven by? Well, inflation, of course. And like we've discussed already on this channel, inflation expectations seem to be going up, especially with such an energy crisis and all the reverberations across the markets. Check this out. This is the 3-year expected inflation as per the Federal Reserve Bank of Cleveland. And so this inflation expectation seems to be hovering around 2%, which is, I think, quite healthy. It only dipped in the wake of the COVID pandemic when it reached 0.65%, but then it shot back up again and reached a temporary high in middle to late 2022, which was driven by Russia's invasion of Ukraine. The actual inflation that happened subsequently was, of course, way higher. I think it's closer to 10%. But this is the expectation. And the expectation then hovered around 2 to 2.5%, and only recently you can see this spike upwards. So we're closing in on the 5-year high again, which means inflation will remain high. And that, of course, will drive corporate earnings, because them raising prices is, of course, how inflation happens. And so we see this all across the board. The most immediate effect is in the fuel prices. And I showed this graph before where you see the fuel prices in the US per gallon of regular gas a year ago and now the current average. And I think that's a 28% increase already. But of course, it doesn't stop there because energy prices have a knock-on effect to other processes down the value chain. For example, food production. If gas prices go up by 28%, then the farmer who has to operate his tractor has to spend 28% more on fuel. But it's not just that. You see here how strongly energy prices are correlated with food prices and fertilizers. And once you see this correlation, it's pretty easy to understand why everything gets more expensive. The farmer has to spend more on energy, which means gas, and on fertilizer, because fertilizers are very energy intensive and high energy prices make fertilizers more expensive. So energy prices directly and indirectly via fertilizers drive an increase in food prices. And that's how inflation arrives at your dinner table. And so whether price increases are directly traceable to energy increases, companies will raise prices. That's how they manage to increase their profits year over year, quarter over quarter. One nice example here is Apple. I brought these examples where you can nicely see the number of iPhones sold over the last 10 years and Apple's revenue over the same time period. And what you can see here is that the number of iPhones sold per year is basically flat for the last 10 years, not much of an increase. Meanwhile, revenues went up by 78%. Okay, 7% increase in number of iPhones sold, 78% in revenue increase. Now, of course, iPhones are not the only product that Apple sells, and they've grown their cloud revenue and AirPods and whatnot. But what I'm trying to say is that the increase in revenue that is to be expected is not achieved by selling more iPhones. It is by making everything more expensive. And so here you can see the iPhone 6s Plus, which was the top model in 2015, against the iPhone 17 Pro Max, the top model of 2025. And as you can see, the 6s Plus started at $750 versus the 17 Pro Max, which started at $1,200, which is a 60% increase. And so that's how it happens. Don't expect these companies to sell much more, just expect that everything to get more expensive. And that's the inflation shock I've tried to warn you about, and why I encourage you to get out of cash and get into real assets, because inflation is coming. And so even the stock market reaching an all-time high shouldn't discourage you too much, because a lot of expectation is built in that these companies will increase their profits a lot, and especially by raising prices. And 5 years down the line, I'm pretty sure you're gonna look back nostalgically to mid of April 2026, when you could have bought the S&P 500 for 7,000 points, because by that time, it's probably at 10,000 points. However, that's a long-term outlook, but I just wanted to give you this perspective because in my weekly series, of course, you might lose sight of the big picture. But what I want to encourage you to do is keep your eyes on the ball, never lose sight of the big picture, and know why we're doing what we're doing. Cool. That's what I leave you with for this week. I'm going to continue observing the market, and I hope to see you next week when I make my next trade. Until then, all the best and take care.